Hello, everybody. Welcome to Citrin Cooperman's construction industry webinar on navigating the new revenue recognition standards. My name is Sal Leone. I am an audit partner at the firm in the New York City office. I will be starting the presentation for you today, and then I'll be passing it off to Sean Kilgore of our Braintree office, who also focuses in the construction industry. He's a partner, an audit partner as well. And Sean will be passing it off to Scott Durko, who is also an audit partner in our New Jersey Livingston office. So I hope everybody is excited to learn about the new revenue recognition standards as much as we are to present to you. Hopefully this webinar will give you the information that you need to navigate through the new procedures. Just to kind of give a general overview of what we're going to be speaking about, there's 5 steps to the revenue recognition policy, and we're all going to be presenting on each of those steps. So just to kick off the webinar, once you take 30 seconds to answer the first polling question, which is where is your company with implementing the new revenue recognition standards, which we're gonna use ASC 606 as a term to kind of summarize the new revenue recognition standard. Is it A, have not started yet, B, just getting started, C, almost complete, and D, ready for the new standard? So why don't you take 30 seconds, answer that polling question, and we'll get right back to you. So it seems like there's a lot of people in the audience that have not started yet. So, you know, maybe after this webinar, people will get to understand it better and implement it, obviously. It's going to come down the pike. It's not going to change. It's definitive. So it's going to come down. And as much as we're in the beginning of 2018, for public companies, the effective date is 1/1/18, and for privately held companies, 1/1/19, as we're going to kind of summarize going forward. So basically, some of the objectives of today's webinar is steps to prepare for and implement the new revenue recognition standard, how to minimize the disruption of implementing the new revenue recognition standard, and the key impacts of the new revenue recognition standard on construction contractors. But before I get into it, there's a couple administrative stuff that I would like to mention. If anybody wants CPE, you have to answer the polling questions as well as answering the survey at the end. So that's key for CPE, and that's basically it. So the effective dates, as I mentioned, for public entities, periods beginning after December 15, 2017 or January 1st, 2018. For privately held companies, periods beginning after December 15, 2018 or January 1st, 2019. There is early adoption permitted up to the public entity adoption date. I have not seen that. Obviously, we're still in the beginning of 2018, so it'll be interesting to see how the public entities are handling the new revenue recognition standards. One benefit for you know, for at least my practice, where I'm handling a lot of privately held companies, where I can piggyback, or we can piggyback on a lot of public entities to see how they you know, handle these 5 criteria, 5 steps, and how they implement it with their financial statements for the public entities that they're handling. There's 2 methods for transition. There's full retrospective, which means all periods presented would report under the new standard. That's related specifically to comparative financial statements. So if you're showing your financial statements on a comparative basis with both years presented next to each other, you will have to present for both of those periods the new revenue recognition standards that we're going to be speaking about today. Or you can do the modified retrospective transition method, which is if you're showing in only the initial period of adoption, it's reported under the new standard, and basically you'll see, you know, change in accounting method. So you'll see a cumulative effect on the beginning retained earnings if you're using the modified retrospective approach. So so those are the two approaches that we'll speak about later on in detail. So, you know, I just want to kind of give the audience background of how this all evolved. You know, with these new revenue recognition standards, sometimes you scratch your head and, you know, you kind of ask yourself, you know, why are they changing the methodology that we're comfortable using? And I would say probably the reason for it is there's a convergence to IFRS, which is the international standards. And basically they also want to develop some type of consistency between not only construction contractors, but other industries. So all different industries have different ways of recognizing revenue, which aren't similar to the construction industry. They want to kind of be a little bit more consistent with all industries, including construction. So as we're going to speak about it, my personal feelings towards this new revenue recognition standard as it relates to construction contractors, I think there's going to be an implementation plan, which you have to go through 5 steps. But at the end of the day, I don't necessarily believe it will be earth-shattering of a change to construction contractors. There's going to be internal control implementation issues and things like that, and you have to go through a thorough assessment before you or during you entering into contracts. But other than that, as we go through it, all the steps, I don't necessarily believe it'll change that drastically. I think initially when they first came out with this, a new idea, that initially they were going to change the construction industry pretty significantly. But fortunately enough for construction contractors, there was a big lobby at the end that they went ahead and basically, you know, updated or modified the proposal to what it's now. So I think that's a good thing for most construction contractors. So, but just to kind of give you the definition, the core principle, so basically the core principle of the new standard is basically a company should recognize revenue to depict transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. So basically, under the old standard or the current standard, 605, that's the current standard, our methodology was based on a contractual basis. 606 is more focused on, you know, documenting or delivering promises or delivering on your services. And it's going to really come down to basically understanding what the performance obligations are. And that's one of the new terminologies under the new standard. And here are some of the new terms that we'll briefly go through as we continue this webinar. Performance obligation that I just mentioned, contract asset, constraint, transaction price, transfer of control, variable consideration, distinct, onerous contract. The one word that if I had to pick out one word on this slide that really kind of determines the importance of the new standard is transfer of control. It really comes down to recognizing revenue based upon the transferring of the control of the product or the service that you're delivering. So I guess as an example, if you're putting up a building, when does the transfer of control happen to the owner? And what is the performance obligation? One of the things that most contractors are going to stand behind is, well, I can't build a half a building and basically, you know, give it to the owner and he's going to pay for half of that building. I have to complete the building, and therefore that's one performance obligation. But that's one of the examples that I would like to highlight up front, and I'll mention a few more examples as we continue going through steps 1 and 2. So the 5-step process that I just mentioned, step 1 is identifying the contract with the customer. Step 2 is identify the performance obligations in the contract. Step 3, determining the transaction price. Step 4, allocating the transaction price to the performance obligations in the contract. And step 5, recognizing revenue as the entity satisfies a performance obligation. So those are the 5 steps. I will be going over steps 1 and 2. Sean will be going over steps 3 and 4, and Scott will be going over step 5 and the administrative behind the scenes requirements that you'll need to, or your organization will need to kind of go through as this comes close and you get closer to adopting these revenue recognition standards. So step 1, identifying the contract. So basically, the contract is an agreement that creates an enforceable rights and obligation, The difference between the current standard and the new standard is basically, currently it's basically contractual legal contract. So you have a contract you entered into for $2 million, and you anticipate that you're going to use up through that contract $2 million of that contract to the end. Under the new pronouncement, now it comes down to accounting contract. You got to determine what the accounting contract. In that existing $2 million contract, there could have been things included in that contract that you never really assessed before. Now you would have to assess things like general conditions. If you have a $2 million contract and a lot of that contract provides for general conditions, you have to do an assessment prior to recognizing any revenue on that contract. What's the likelihood of you using all the general conditions within that contract? Another key example as we get through this, and we'll kind of go through the intricacies of how to recognize things. One of the biggest changes of this new revenue recognition standard is if the contract provides for bonuses for early completion or liquidating damages for not completing on time. You have to assess the likelihood of you being able to recognize that bonus, because now under the new standard, you'll be able to recognize that bonus, and you have to determine the likelihood of you being able to meet that bonus deadline or the liquidating damages. If you feel that you're not going to be able to meet that deadline, you have to account for that cost. And usually under the old standard, you would account for that in the estimated cost to complete. Now it's upfront with the contract value, how much you're going to be, and you have to back those things out of the contract value. So although it doesn't change that much, I mean, me being a conservative accountant, I'm not very comfortable recognizing, and I would say most business owners in the construction industry would be comfortable recognizing a bonus based upon an estimate. And as we get through this presentation, we'll go through the details of how to come up with that estimate and how to recognize it, because it's not very clear. It's not exactly 100%. You have to go through an assessment. The biggest thing, which I just mentioned, is collectability is probable at inception. So I'm going to go back to my example of the $2 million contract. Hopefully you never really enter into a contract that's really not, that you feel that you're not going to collect on, but now you have to determine whether or not that $2 million is fully collectible, or if there's bonuses or liquidating damages that could prevent you from collecting that $2 million contract. So if you go through the assessment and you determine that, you know what, that $2 million contract is really not $2 million, we believe we're not going to hit those general conditions, or we believe we're not going to hit that bonus, you have to scale that contract value back to whatever you believe it is. The criteria is approval and commitment of the parties, identification of rights and payments, commercial substance, and then, which I just mentioned, collectability is probable at inception. Now, the contract could be implicit or explicit. It could be in writing or it could be verbal. Those all have to be hashed out initially with when you first identify when you enter into a contract, basically, and make sure you're accounting for it properly. The one example I would like to use is, an HVAC company. You're doing you first, install the requirements to kind of get the mechanical work in, and then after you basically install that, you're selling a service contract after you install it. Basically, my understanding, those are two distinct performance obligations. Obviously, you have to go through the details, but those should be separate and distinct and recognized as two separate contracts. But we'll mention that later on as well. That's another example of how some of the performance obligations will be split up. So the steps of evaluating collectability, the amount expected to be collected versus the stated contract value. Again, bonuses and liquidating damages. mitigating items that reduce risk of non-collection. So these are the things that you can prevent items for non-collecting. Right to terminate services for future transfer of goods. Enforceability of prompt pay by law. Advanced payment through overbillings or mobilization. Lien rights. Most of the time, subcontractors have lien rights that if you perfect the lien correctly and properly, you're able to collect on your contract that you're owed. So basically, that's a mitigating factor to reduce the risk of non-collection. That would also go into your assessment of determining the contract. So one of the things that they mentioned in the standard and comparing it to the old rules is the combination of contracts. So under the old rules or the current rules, it was an elective or an optional type of, it was optional whether or not a contractor wanted to combine two separate contracts. If it made sense, you would have to go through an assessment, which would be the contracts are negotiated as a package in the same economic environment with the overall gross profit margin objective. The contracts constitute an agreement to do a single project. The contracts require closely interrelated construction activities. The contracts are performed concurrently or in continuous sequence. The contracts constitute in substance an agreement with a single customer. The one thing I like to kind of point out on the old or the existing rules is if, you know, I have many contractors that are doing work downtown in the World Trade Center. Now you have multiple buildings going up at one site. Most of those contracts were negotiated at the same time. So some of my contractors would elect to kind of show them as one contract. Obviously, under the new standard, you have to basically, it requires a contract to be combined when entered into at or near the same time with the same customer, and if one of the following is present: negotiating as a package with a single commercial objective. Amount of consideration to be paid in one contract depends on the price or performance of the other contract. Goods or services promised in the contracts are a single performance obligation. So now you're required to basically combine those two contracts if you meet the criteria that I just mentioned. And that's one of the bigger differences between the two methodologies. So that's something that, you know, as you're going through your assessment, you know, if there's I mean, I guess if a lot of the people in the audience are doing work in New York City, the building's going up at the Hudson Yards. If basically you're negotiating some of the projects at the same time, you have to do an assessment to determine whether or not you meet the criteria and those contracts should be combined. So that's one of the bigger differences as well. Step 2, identifying the performance obligations. As I mentioned earlier, once you get through identifying the contract, then you have to basically go through and identify which performance obligations that you can separately identify. So basically, it's at the contract inception, you identify different performance obligations. And basically, as modifications to the project occur over the life of the contract, i.e. change orders, you have to determine whether or not those are separate performance obligations or they should be combined in the base contract. Now, the argument, well, most of the contractors that I'm working with, well, if you have change orders that you missed initially when you negotiated the contract, and as you continued on the project, you identify things that have changed in scope, but not necessarily changed, you know, not necessarily have a different performance obligation. So under those circumstances, I believe it would be a part of the base contract, and that would be the same performance obligation. You wouldn't have two distinct performance obligations. As I mentioned, again, I think contractors will have a position to stand by their business to kind of understand what they're doing. If it's an electrical contractor and they have to deliver the building with all fully electric, you know, all the electric wires ran and up to date, those I would think would be a performance obligation. Again, you would have to do a separate assessment to determine if there's separate performance obligations within the contract that you would have to recognize separately. So again, there's explicit and implicit promises. So basically on the implicit promises is if you have a contractor that their past history is, you know, providing the services after they perform the initial contract, you have to assess that and potentially show that as a different performance obligation as opposed to combining it all together. The example that I mentioned was, I think, a perfect example is the HVAC contractor, who's going to be in charge of, installing all the structural work in the beginning, and then, selling a service contractor right after. So it sounds like, and that's probably the quickest or the best example that I could see right now, that I think those you have two separate performance obligations that should be potentially separated and recognized separately rather than together. So there's two criteria that you have to, there's two primary items that you have to go through to determine if two separate performance obligations have to be recognized. And you have to determine whether or not the good is distinct by itself or a series of substantially similar distinct goods or services that may have the same pattern of transfer. So if you meet these two criteria, then basically if they're distinct from each other, they would have to be recognized separately rather than together. A good or service is distinct if a customer can benefit from the good or service. Back to my example. If you're building a building, you're a superstructure contractor, can you just deliver the owner of the building a half of the building? No, it sounds like you have to, deliver them the full building in order for you to, to accomplish your contract or fulfill your contract. So I would say that's a one performance obligation. It is separately identifiable from other promises in the contract. Going back to the building, I would say, if the building is put up and then you have to do some other work that's outside the contract after the front or the building is up, those would sound like they would be two separate performance obligations. So back to the definition or to the slide, isn't used as an input to produce a combined output, doesn't significantly modify or customize other goods or services in the contract, isn't highly dependent or interrelated with other goods or services in the contract. So that's the definition of whether or not a good or service is distinct. So obviously you have to review your contracts, determine, if there's any outliers outside of your ordinary contract that you enter into, looking at the details of the contract, and understanding what the performance obligations are, basically, to determine if you need to separately state those two. One of the examples in the standard is that we wanted to kind of let you know about is warranties. So assurance type warranties is sort of like the general warranty of the contractor, implicitly kind of letting the customer know, well, you know what, after a couple of months we'll come back and fix it. That sounds like that would be within one performance obligation. A service type warranty where someone has the option to purchase a warranty outside of the contract, that would be a separate performance obligation that you would show separately. So I think it really comes down to understanding what affects or what's included in the contract and what's being offered to the customer to determine whether or not there's two separate performance obligations in the contract. So a couple things to consider as you're going through this process as it relates to internal controls and procedures in your company. What procedures do you currently have in place to monitor and identify contracts? What procedures should be implemented to identify all distinct goods and services within the contracts with customers? Does an independent review occur for determination that are made in regards to separate performance obligations identified within a contract? How does your company verify there is consistent judgment and application in identifying performance obligations? One of the things that I'm advising a lot of my clients is, since this standard is effective, January 1st, 2019, all the jobs that you're currently entering into that you anticipate that would go beyond this year, 18, into 19, perform the assessment and go through the process, these first two steps, because that's going to really be the baseline of you determining steps 3, 4, and 5. So, although, I'm not sure how, the computer software systems or companies are implementing this right now. I heard that they're not really up to par with these new revenue recognition policies. So you might have to do like a little bit of a manual process, sitting down, understanding the contract, and basically what you're providing within the contract to determine if, what the contract value is, obviously, and what the performance obligations are within those contracts to determine, to kind of move to the next step. So, some of the things that we're doing as a firm is, now that we're going through audit season and we're out in the field, we want to understand from the client's perspective what contracts that they have currently outstanding that they anticipate will not complete within the year, and basically getting a head start to kind of go back, because you have to go back. There's no option. So either way, whether or not you take the retrospective approach or the modified approach, you'll have to go back and identify these contracts, the ones that are not complete, by January 1st, 2019. You'll have to go back and go through this. So, time is of the essence. Now that we're not pressed for time, we can kind of have the time patiently, call your service providers, call your accountant, call your consultants, call Citra Coopman to help basically go through this process. We're happy to help. And I'm going to pass it off to Sean to go through steps 3 and 4. Sean, you can take it from here.
All right. Thank you, Sal. So now that we've gone through steps 1 and 2, we know that we have a contract and we've identified how many performance obligations. I'm going to walk you through steps 3, 4, and 5, which basically are to identify the transaction price, and then how do we allocate. Step 4 is how do we allocate that transaction price, and then how do we recognize the revenue, and is it different from where we are now? So the first step is step 3 out of the next 3 steps that we're going to be talking about, and that is really probably one of the biggest changes, is determining the transaction price. So some key concepts that we're going to discuss are variable consideration, and then how do you estimate this variable consideration. There's also a new concept called constraint, and so we'll go over a few examples of that. And the key for this step is going to be developing new accounting policies, as Sal had mentioned. I think, as you'll hear from all 3 of us through this webinar, the key is to get in front of this and develop policies so you can document. So if you have an audit, you have the documentation as to what the value of the contract is. So transaction price, and this is a little bit different, I think, than where we are now, in the fact that I know a lot of our clients take a conservative approach when it comes to variable consideration. But two key terms here, again, are variable consideration and constraint. So the transaction price is not necessarily the contract price. The key difference is variable consideration. And while these things exist and they occur on contracts every day, such as unapproved change orders, liquidated damages, bonuses, shared savings, many of our clients now, especially with unapproved change orders, they may wait until they're 100% certain they're going to receive the change order before recognizing the revenue. Well, that concept can no longer be applied. You may still get to the same point, but you have to go through the 5-step process of determining estimations of the variable consideration with the contract price to determine whether or not you're going to include it. So there's 2 methods for estimating this variable consideration. One is the most likely amount, and that's pretty much a yes, no. Yeah, we're going to get we're going to get approved for this change order. We're going to hit some bonuses. Or the second one is expected value, where based on a scenario, you might have multiple outcomes. So, and that's probability weighted. So here's a very high level example of the most likely amount. We'll walk through it real quick. So if you have a $100 million contract to construct a bridge, there's a $10 million performance bonus if it's completed by July 1st. So you have a potential contract or transaction price of $110 million. It's a single performance obligation, so we're not splitting it out with multiple obligations. at the inception of the contract, and this is where we talk about you need to document. So if you have your auditors come in, they're going to want to see how you determine your contract value or your transaction price. So the company determines at inception that it's 40% likely, and this is based on historical data, jobs that are similar, that they're 40% likely that they're going to get this complete by July 1st to hit this performance bonus. If that's the case, so when you record the transactions price, you'd record $100 million. You wouldn't record the bonus of $10 million. And again, the key is to evaluate past performance and then other factors that go into the job. So at 40%, it's not likely you're going to get that. So when I said that, documentation is may get you back to where we were with recording unapproved change orders only when we're 100% confident, you can see how you can get there based on documentation. Here's another example, the same example, but in this case, we're saying, after a few months into the job, we're really confident, we're 85% sure that we're going to get this complete by July 1st. Same contract, and in this case, we'd record the $110 million. So this is where you see, in the benchmark really is about 70%. So once you're certain that you're going to get an unapproved change order or you're going to hit a bonus and you're 70% confident based on either prior jobs, customer history. So if you have change orders and 90% of the time these change orders get approved with this customer, you're going to have to record that. So in some circumstances, I think our clients are going to actually recognize more revenue than they have historically. The other one that I mentioned when looking at variable consideration is the expected value, and this is when I think liquidated damages give a good indication of this. So in this example is you have a $100 million fixed price contract to build the casino. There's $100,000 per day liquidated damages if you don't complete it by September 1st, 2019. So it's really difficult to determine what the job conditions are going to be and what these liquidated damages are going to be at the inception of the contract. But you do have to do some sort of analysis. So the company went through this example and they said, 50% probable that we're going to get this job done on time, and then 20% by the 15th, 25% by October 1st, and 5% probable that they're going to complete it by the 15th. So there's multiple outcomes here. So in this case, you can see on this slide, we go through and we basically weight the probability on the damages. So, if it's 15 days late, total liquidated damages are $1.5 million, and there's a 25% probability. So you're looking at adjusting the contract down $375,000. So you can see you go through all the scenarios, all the probabilities to get to 100%, and then you record basically to come up with your transaction price of $100 million less than 1.2 and liquidated damages at 98.8. So but this is key because this is prior to the constraint concept. So this is just, we're coming up with the value of the contract based on what we know and the fact pattern and contracts that are similar. So this is where constraint comes in. And the whole concept of constraint is it's to include revenue to the extent that it's probable. What the standard doesn't want to do is have you recognize either too much revenue or too little revenue. Really, the goal is to get the revenue to what it is actually. So that's why they say based on history. So this constraint is saying if you're not above 70% sure you're going to get this revenue, they don't want you to include it. So on that example, I'm going to go back here, and we're going to use this constraint concept. So first we figured out the value, and we included the total $1.2 million out of the liquidated damages. Then we go in and we figure out constraint. And what we do is you're going to look at your contract and say, okay, at what point do we get to exceeding 70%? And in this case, we're saying we're 75% sure that we're going to have liquidated damages of $375,000. So then you compare that price to the other price, and in this case, you record the 99 because at the inception of the contract, you're 75% sure that this is basically going to be your contract value or your transaction price. So some key things to think about when determining step 3 will be, an accounting policy. Well, really, you're going to have strong controls over your contract value, especially if you do large contracts over multiple years. Obviously, these variable considerations are going to change quite a bit. And then you're also going to have some sort of policy and controls in place over the evaluations, the constraint on the contract. So these are all going to have to be documented, especially, as I said, if you have an audit, all these documentations will need to be provided to your outside CPA. Again, as I mentioned, it's important that you look at the assumptions of the contract. Obviously, as you get closer to the end of a contract, you're going to have more confidence as to whether or not you're going to hit certain provisions. And then the final point on step 3, I want to, as always, I think the consideration of materiality is crucial. I don't think that you want to go through a lot of these calculations and be making changes on a contract on a quarterly basis or on every 6 months for an immaterial amount. I think you'd only make changes if it's material. So that concept really isn't going to change from where we are today. Some different disclosures, or, as I've heard in the public, as Sal mentioned, the public companies are coming out as we speak with their first quarter, but the disclosures are going to be a little more comprehensive than what you're used to seeing in your financial statements now. And I think the biggest piece is you're going to have to document in your financials how you determine the contract value. You're going to have to document and explain to the reader what goes into the variable consideration. And then obviously you're going to have to document if you have a significant change in the contract. So now that we're through, we know the transaction price. We come to step 4, which is to allocate the transaction price. And this is, the objective is to allocate the transaction price to each performance obligation in an amount that depicts the amount of consideration the entity expects to be entitled in exchange for transferring the promised goods or services. So essentially, if these performance obligations stand alone, what would you sell them for? So topic 606 defines the standalone selling price as the price the entity would sell a promised good or service separately to a customer. So sometimes if you have one contract, let's say, the multiple performance obligations may not be easy to determine what exactly is a standalone price because it's all combined. So in step 4, and for a contractor, I think it's going to be a little bit easier because when most of our clients do a bid, they know the costs and they know the margins they're getting on a job. So while there's 3 methods, adjusted market assessment, which would be the fair market value, the expected cost plus a margin is really if you have multiple performance obligations, this is how most likely you will end up allocating the transaction price to the performance obligation. Step 5, as we come to now, is recognize the revenue. And as Sal had mentioned, I think at the beginning, it's really about when the customer obtains control. And there's 2 methods under 606 as to how you can recognize revenue. The first is at a point in time, and then 2 is over time. The good thing is as opposed to when the standard first came out, I think this is going to be very similar to how most of you are recognizing your revenue as we speak. I don't see a huge difference between how 606 recognizes revenue on a long-term contract versus 605. So the core principle, and this gets into kind of the test of, all right, how are we going to recognize our revenue? And this is where you're going to see that most of your jobs are going to fall into this one, performance obligation recognized over time. So look at number 2. If you look at these 3 circles, and if it's not over time, then it's considered a point in time. So if you don't meet one of these 3 criteria, then you're going to recognize your revenue at a point in time. For contractors, I would focus on the second and third circles. So the entity performance creates or enhances an asset. that the customer controls. Okay, well, if you're building a building in downtown Boston, and I don't think that you can control the building. It's really the customer controls that. So I think a lot of our contractors are going to fall into two, and that's going to be an easy way for them to stay on the percentage completion. The third one, the entity's performance does not create an asset with alternative use. I think that speaks for itself. But the biggest piece, if you're going to default to the third circle here, is that you have right to payment for performance completed to date. So I think it's going to be pretty straightforward for most of you. There are a few, I'll say, a few little nuances within recognizing the revenue in step 5. One is installed materials, uninstalled materials. So I gave an example here, and I think there were many different ways in which uninstalled materials have been handled. And now this is trying to get it so that it's all handled the same. So in the example, I have a $100 million bridge project, deliver $20 million in steel to the job. If it's not delivered to the job, then it could be considered inventory. So what you're going to do in your contracts going forward, if you do have a lot of materials, you're going to carve out the uninstalled piece from the contract, and really you're recognizing the revenue based on the labor as it's installed. So we'll go through a brief calculation. I don't want to get too granular, but you can see the contract with the transaction price is $100 million. We have $20 million of steel, $40 million of labor for a total cost of $60. You come down and we say, hey, look, we have the steel on site. We've done $10 million in labor, so our labor is 25% complete. So we recognize the revenue based on that labor of 25% complete. So we take the transaction price, we back out the steel, and we recognize $20 million of revenue. Then what you're allowed to do is recognize the cost of the steel, but no profit. So you recognize $40 million in revenue, and then you have your $30 million in cost, which is the steel plus the labor. So your profit to date in this scenario would be $10 million. And again, these slides will be available so you can walk through the details of this calculation if you want later. Loss contracts, there'll be no changes to how you're currently doing it. So one nuance is the capitalization of costs of fulfilling a contract. And this, for large GCs, I think that there might be a little bit of a change here. So an entity shall recognize as an asset the incremental cost of obtaining a contract with a customer if the entity expects to recover the costs. And what would happen here is that these costs would be pulled out. And one of the issues, I'll say, that's come up is how to deal with bond costs. So some of these the cost of getting a bond for a project would be pulled out of the job and amortized. So this is a little bit of a difference. It's going to be a different presentation. Economically, it's not going to be different, but it certainly will be a little bit of a different presentation. And for those that rely on bonds, obviously intangible assets are something that bonding companies do like to pull out of working capital. So I think there might be an education with the bonding companies as to how this new pronouncement is going to impact the balance sheet. Retainage is another little tweak where if you have retainage, that's waiting on sign-off. So it's not just you've done everything and you're waiting to collect the retainage, but the retainage is actually you need to go back and do some performance. Then that will actually be pulled out of accounts receivable. It will no longer be called a receivable. And again, that's only if you need to perform additional work to get the retainage receivable approved by the customer. So now we've come to our second polling question. So who is going to be affected the most by ASC 606? So if you take a few moments to answer that, and then Scott's going to take over from here and give you some guidance on how to implement everything Sal and I have spoken about this morning.
So the most common answer to that, thank you, Sean, is the accounting department. That's the first. The outside auditors will be the second. And everybody thought the owners would be least likely affected. Actually, you know what? As I read, everyone will be affected. So that's funny. So just an administrative item. I did not mention it earlier in the presentation. If anybody has any questions, obviously as we're going through the presentation, we'll try to answer them as best as we can. But if you want to leave them to the end, that's fine. We'll leave some room. Hopefully we'll have some space or room to kind of answer all the questions that we can. So you just, fill them out and we'll try to get to you. If we can't get to them, we'll get you answers in the next couple days or a week. So I pass it off to Scott Durko.
Having a little bit of a technical issue. Just give us a second.
You can't. I can't. You want to take one? Yeah. 38. Good.
Okay, thank you everybody for your patience. Sorry about that. So for these next few sections, I'm going to talk about the different transition options. Sal touched on them in the very beginning of our presentation. After that, I'm going to talk about the disclosures that are going to be involved. And lastly, I'll talk about what we need to do to put an implementation plan together. So starting off with transition options, basically companies are going to have two options to consider when they implement this standard. There's the full retrospective approach and the modified retrospective approach. And this is actually going to be an important decision because this is really going to impact the level of effort that we're going to need to implement this. Okay. Under the full retrospective approach, Sal touched on this earlier, but I'm going to go into a little more detail into each of these approaches. Under the full retrospective approach, an entity is going to apply the new standards to all periods presented in the financial statement. So what that means is if you're showing comparative financial statements in 2018 and 2019, you're going to show both periods as if the new standards were in effect for both periods. So what that means is you're going to have a cumulative catch-up adjustment to beginning retained earnings in 2018, and all contracts presented in the statements, both completed and in progress, are going to need to be presented and accounted for as if these new standards were in place since inception on each contract. And lastly, since there are probably going to be changes to the 2018 statements, there are going to be disclosures required to tell the reader exactly what changed from 2018 to 2019. Now, one thing to consider is if we're picking this approach, since both years have to be presented using the new standards, this method may require a little more time and resources to implement. However, as I get into the next option, there are some issues to consider there as well. So under the next option, the modified retrospective approach, if this is the approach that we're going to take, then the entity shall recognize the cumulative effect change to opening retained earnings in the year of adoption of the new standard. So what that means is if we're showing comparative financial statements in 2018 and 2019, 2018 would be presented under the old accounting standards and 2019 would be presented using the new accounting standards. So we would have that cumulative catch-up adjustment to beginning retained earnings in the beginning of 2019. And in the year of adoption, companies must disclose what revenue would have been under previous U.S. GAAP. So in essence, what that means is in 2019, in addition to presenting everything using the new standards, there is also going to be a disclosure which is going to require companies to basically tell the reader what revenue would have been under the old standards. So in essence, we're going to have to calculate things twice. And one of the concerns with this approach is there are going to be changes in the recognition of revenue and expenses in the year of adoption versus how it was treated in prior periods. So, some of the concerns we're going to have to think about, first of all, relating to revenue. If the new standards wind up accelerating how revenue is recognized, what's going to happen is our overbilling from our prior period is going to be reduced, and that adjustment is going to go to that cumulative effect adjustment that's hitting retained earnings. So in essence, what's happening is that's going to reduce the amount of revenue that's going to reverse in future periods. And the other thing we're going to have to consider is costs. As both Sal and Sean mentioned, costs are going to be treated a little differently under the new standards. So, some expenses or some costs rather that we were able to expense in prior periods now have to be capitalized and amortized under the new standards. Sean mentioned bond premiums, mobilization, things like that. So those are things that we're going to have to consider. So now we're going to talk about disclosures. And, the main objective of the disclosure requirements under this new standard is, companies are going to disclose enough information to enable the readers of the financial statements to really understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from these contracts with customers. So in order to achieve this, the new standard requires that companies disclose both qualitative and quantitative information in their financial statements about its customers, contracts with customers rather, the significant judgments and changes in those judgments in applying these new standards, and any assets that are recognized from the cost to obtain or fulfill a contract with a customer. Now, as Sean got into some of the detail about some of the additional pieces of information that are going to be required, and as you're going to see in the next few slides, the disclosures required under these new standards are going to be much more extensive. Up to this point, everybody's read the standards, or a lot of people have read the standards, but there have been no real concrete examples out there to give us an idea of what the disclosures are going to look like. But public companies are applying these new standards this year, so we're actually going to get an opportunity to see some real-life examples this year. I've heard some people estimate that on public company statements, these additional disclosures can possibly add 8 to 10 pages of additional disclosures. But, for private companies, I wouldn't expect it to be as extensive, but I think we can all expect that there are going to be a significant amount of additional disclosures. So let's talk about some of the disclosures that we're going to have to include in our statements. Regarding contracts with customers, companies are going to have to disclose all of the following amounts for the reporting period. Revenue recognized from contracts with customers separate from other sources of revenue. And companies are going to have to disclose separately any impairment losses on any receivables or contract assets arising from contracts with customers, which the entity shall disclose separately from impairment losses from other contracts. Disaggregation of revenue. I talked about qualitative and quantitative disclosures that are going to be required. From a quantitative standpoint, companies are going to have to include disclosures discussing the transfer of goods based on transferring those goods at a point in time versus transferring them over a period of time. And there's also going to be qualitative disclosures where companies are going to discuss how economic factors affect the nature, amount, and timing and uncertainty of revenues, such as types of customers, geographic locations of customers and contracts, as well as the type of contracts. Contract balances. An entity is going to be required to disclose the opening and closing balances of receivables, contract assets, and other liabilities from its contracts with customers, if it's not otherwise disclosed separately in the statements. Sean touched on these before, but a contract asset, if the company has, if there's a right to payment is contingent on the entity performing additional acts, this entity does not represent a receivable. Instead, the standard refers to assets as a contract asset, and liabilities, a contract liability represents an obligation to transfer goods or services to customers in the future for which payment has already been received. We talked about performance obligations, but basically companies are going to have to disclose information about each of these performance obligations and talk about a couple different things. One, companies are going to have to disclose how the performance obligation is satisfied. Is it satisfied based on shipment or delivery of the product, as the service is rendered, or upon completion of the service? If there are significant payment terms that warrant disclosure, is payment typically due? When's payment typically due? Is there significant financing components involved in the contract? And if there's variable consideration, how that factors into the contract. Significant judgments. Sean mentioned this earlier, but companies are going to have to disclose the judgments that are going into determining the contract amounts and in applying these new standards. And basically, judgments and assumptions are going to have to be constantly evaluated throughout the contract. So if there are material changes in the contract amount based on significant events that happen on the job, liquidating damages, bonuses for early completion, those things are now going to have to be explained in the financial statements. We're also going to have to talk about the timing of the satisfaction of the performance obligations, the methods that we use to recognize revenue, and there's going to be required disclosures relating to the transaction price and the amounts allocated to the performance obligations. So there are going to be a significant amount of disclosures that are going to be involved, and we are going to have to talk about a lot of things in the statements that weren't necessarily required before. So, that is going to be a significant change, I think, to some of our contractors. Now that we've talked about some of the changes that are involved in the new standards, let's talk about how companies can put a plan into effect to actually implement these standards. As part of putting any plan together, there are going to be several implications that we're going to have to consider. First thing I mentioned, there are going to be increased disclosures. There's going to be a significant increase in the amount of disclosures. So, companies are going to have to take a step back and look at the processes they have in place, procedures, controls, and ask themselves, based on that evaluation, are they going to be able to gather the information that is going to be required for these disclosures? Tracking of separate performance obligations. Any separate performance obligation is going to require costs, billing, and revenue recognition to be tracked separately on each of their contracts. And question a lot of companies are going to have to ask themselves are, right now, do we have the capabilities to do something like that? Surety considerations. Since most contracts are generally bonded under a single surety bond, the sureties, they're probably going to want to see the combined results of certain projects. They're not going to want to see them broken out into separate performance obligations. So that may be something that we're going to have to consider as well. Banking considerations. If companies are going to start recognizing revenue differently, that may or may not have an effect on their loan covenants. So that's something that's going to have to be looked at. And if that is the case, then companies are going to have to talk to their banks about changing the wording in some of their loan agreements. Accounting software, I'll fly through these a little quicker as we're starting to run towards the end of the presentation. Accounting software, a lot of the software companies they're working to incorporate these changes right now. They're not quite there, but they are working on it. Book to tax implications. Right now, the tax rules are not necessarily consistent with these new rules that are required for GAAP. So we're still awaiting for guidance from the IRS. They haven't yet said whether they're going to conform to the new standards. So from a tax planning perspective, this is something that we're going to have to look at closely. Other things, compensation considerations. Companies are going to have to take a look at the contracts and sales agreements and determine if there's any additional changes that they're going to have to consider when they're looking at the wording of these documents. And lastly, additional time and cost. Companies have to realize that this is going to require some additional time, cost, and effort internally to take a look at the existing policies and procedures they have in place and determine what they need to do to change those policies and procedures in order to be able to comply with these new standards. In putting a plan together, Sean mentioned this earlier, but we really have to start planning for this now and thinking about it now. One of the things I would recommend is working backwards and putting a timeline together. If we know that, these standards go into effect January 1st, 2019, I'd work backwards from there. We're already almost in March, so that gives us about 10 months to prepare. And, as we're going to talk about in these next couple slides real quickly, there are a lot of things that we're going to need to consider as we move forward. First thing, in putting a team together, I would assign an individual who's going to take the lead. I think any project, you need to have somebody that's going to really lead this project. What they're going to do is they're going to put together the team. They're going to take the lead in understanding this new standard. And, I think it is important to note that the leader doesn't necessarily have to be somebody from an accounting and finance. This really just needs to be somebody who is going to be able to keep things moving forward, who's going to be able to hold people accountable and really be organized. In putting that cross-functional team together, it really should consist of representatives from various departments, and everybody's going to be at least a little bit affected by this new standard. Accounting and finance, obviously, but project management is going to have to be involved, estimating, legal, and HR. In putting a plan together, at these early phases, I think you don't need to really get involved in the detail, but you're really at this point just laying out a general framework for how this plan is going to work. So your leader is going to assign roles and expectations to the people on the team. You're going to document this plan as it develops, and Sean mentioned this earlier, but I think that's going to be a really important factor in this, because this is not only going to help you in terms of developing new policies and procedures for your company, but, at the end of the year, your accountants are going to need this in order to get comfortable with what you're doing. The team should be educated on the new standards. Timeline should be laid out. The leader is going to monitor the progress and make sure everybody's, staying on track and meeting these timelines. And during this process, you're going to develop an understanding of where these new standards could have the greatest impact on your company. So at this stage, now, next thing is you have your team together. You have the framework laid out on how you're going to implement this. The next thing is really get your people together and talk about where are the key areas that these standards are going to have an impact. And this is really like a big brainstorming session. Some of the key areas that likely will be impacted by this new standard include compensation, debt arrangements, bonding capacity, internal controls, software. We talked about that. Tax planning. I think we're going to have to be a little more proactive on that. Identification of contract and performance obligations. How variable consideration is going to be measured. How the prices and the costs are going to be allocated to these different performance obligations. And will these new standards actually accelerate revenue or slow it down? Sal mentioned this earlier, but I think the next thing would be to take a look at your current work in process schedule and start grouping your contracts together based on similar characteristics. Similar types of contracts, similar contract terms. Identify some of those contracts that may have multiple performance obligations. Identify some of those projects that may have some uninstalled materials that may be an issue. Are there variable considerations, bonuses for early completion, liquidating damages, and are there warranties? And then once you do that, pick one or two projects out of that group and try applying the standards to those contracts. And, what's going to happen here is companies are going to realize where the holes are in their existing process, and then they can use that information in putting together a plan for how are they going to revamp these processes and procedures to be able to comply with the new standards. So when you're at that step, these are the things that companies are going to consider when they're putting together these new policies. How are they going to identify contracts that meet the new standards? How are they going to identify contracts with performance obligations? Allocating costs and prices, allocating identification of the accounting for the variable consideration, uninstalled materials, warranties. These are all things that are going to have to be incorporated into the new policies in order to identify these issues and be able to implement. Now as we get towards the end, at this point we should probably be in the summer or the fall. And at this point, I think we take a deeper dive and, take a WIP schedule from an interim period and actually apply the new standards to this interim period. And this is an important part, because this is where you're really going to determine the potential impact on the financial reporting. You're going to determine the impact of the adoption method. Does it make sense to go with the full or modified approach? You're going to identify those potential qualitative and quantitative disclosures. You're going to start developing a process to accumulate the information. You're going to start, starting the process of drafting your wording. And, you're going to really be able to test the effectiveness of these new policies and procedures you developed, and you run them parallel with what you have existing, and you can identify areas where you think, we need to tweak it further. And then once you get through this, at that point, now you're probably in the fall, late fall, and I think this is where you start having some in-house training. You educate your team on the background of the new standard, how the company is going to adapt to comply with the new standard, and here's where you're going to start rolling out policies and procedures. And lastly, once we've determined what the impact of this new standard is going to be, at this point, now is where you're going to have to talk to the stakeholders about anybody who's getting these statements. Now we need to communicate with these people and really communicate how this is going to affect our statements, how this is going to affect our numbers. So banks, obviously, because, if it's going to affect loan covenants, things like that, they're going to need to understand what's changed. The sureties, obviously, board of directors, executives, any investors, anybody that's relying on these statements, we should be reaching out to them to explain how this new standard is going to impact our statements. And the very last point is, I think it's important that companies work with their outside accountants and auditors to, work through what they've done over the year to apply these new standards. And, this is going to be important because at the end of the day, the accountants and the auditors are going to have to get comfortable with what the company's doing to implement these standards, particularly if, the company's undergoing an audit at the end of the year. So we come to our last polling question. And after listening to this presentation, how do you feel about implementing this new standard? Piece of cake, no problem. I will need some outside help. My CPA will figure it out. And I'm not considering changing professions. I'll give you about 20 seconds to answer, and then we'll wrap it up.
So most of the answers that are coming in is I will need some help from I'll need help from outside to help implement. I'm glad that people realize that they need help. Obviously, talk to your CPA, your advisors, and basically, I think as a team, you'll collaborate and come up with the right approach that satisfies everybody that's using the financial statements. Before we cut off, I know we're short on time. There was a few questions that came in. We can answer them pretty quickly. At least one of them we can. One of the questions, I'll repeat it, I'm paraphrasing. Do you anticipate companies not wanting to implement and take an exception to GAAP? What is your sense on how bonding companies and banks? That's a great question, a very common question. My opinion, and I'm not sure if it aligns with Scott and Sean, is I think it might be pervasive enough to kind of not being able to issue an opinion. The differences between the old GAAP and the new GAAP, or the new standard and the old standard, might be so significant where your audit firm, whoever that is, might not be able to issue an opinion with just an except for, just because the magnitude of the change. So in order for you to figure out what that magnitude is, you have to go through the process anyway. So if you're going through the process, why not just adopt the standard and be done with it? it's a great thing that you're going to have if you could get there, or if your outside firm could get to the except for opinion, that'd be great. But then you would have to speak to your banker or your bonding company and see how they feel about the except for paragraph, because a lot of these bonding companies or the bank has a requirement in the agreement that says that it must not be unqualified. It must be unqualified. So there should be no exceptions in there. So you'd have to go back to the bank and tell them why you can't do it. And, I think all that effort, why not just start the process early enough, get everybody aligned, and move forward? There is a lot of work, but I think it's all workable. I think the fact that the public companies are doing it right now, we can piggyback on them and move forward together collaboratively. Obviously, if you need any assistance from Citra and Cooperman, Sean, Scott, and myself, we're available. And then the next question was, can you go through an example of a contract to be completed over 6 months? Just because of time, we're not going to go through it, but we'll get back to you on that once we if you want to send the details of what you're specifically asking about, that would help as well. But other than that, I really thank you for all your time. Sorry we're over a little bit. We've had some technical difficulties, but if there's any other questions that come out afterwards, please feel free to give us a call or email us, and we're more than happy to kind of go through anything you would like. There is a survey coming up, so if you want to qualify for the CPE, obviously you have to go through the survey. Thanks again.